Over many years, countries have tried to address tax loopholes and mismatches between jurisdictions, but several planning areas have remained, one of them being debt structuring to achieve the most tax-efficient capital structures. Debt structuring has provided many multinationals with a high degree of flexibility to manage their global tax. Attempts by countries to limit deductions and protect revenues has been patchy, but this is changing. Recent OECD guidance moves us to a more consistent international approach to prevent tax base erosion. Action 4 of the OECD BEPS plan targets debt structuring techniques. It requires governments to apply a limit on interest deductions at a percentage of earnings before interest, tax, depreciation and amortization. The UK will implement this from the 1st of April 2017, and other EU member states that don't already apply a limit will also have to impose one soon.
The rules will operate on an aggregated UK position of all UK members of each group, requiring a schedule to be prepared showing all relevant figures. The rules focus on net interest expense, which is calculated as interest expenses less interest income. Rather than any sort of SME exemption, the rules will not reduce UK net interest expenses for a group below the £2 million de minimis level. A fixed ratio will allow deductions up to 30% of tax EBITDA, whereas a group ratio rule may permit higher deductions where the group's overall ratio of external interest to EBITDA is higher. In both cases, there will be a restriction to prevent UK net interest expenses exceeding the group's overall net interest expense. These limits will operate for all. There is no need for HMRC to prove that there has been tax avoidance. In this example, there would be a taxable profit of £5 million under the new rules, as interest relief is given for only 50% of the interest paid. The tax liability is now £950,000, as opposed to £475,000 in the previous period under the existing rules. If the group's overall external debt ratio had been lower, this company would have had an even smaller deduction and an even larger tax bill.
There are likely to be some groups, particularly those in the real estate sector, and international groups, and perhaps private equity-backed businesses, that may have significant limitations to their interest deductions. We believe that the £1 billion a year of additional tax that this new limitation is expected to raise for the UK Exchequer will come mostly from these groups. There are also a number of less obvious consequences, such as an impact on planning for acquisitions and expansions, and more generally, structuring and restructuring, and an impact on the compliance side of things as well. On compliance, whilst the worldwide debt cap and its gateway test will be repealed, careful monitoring of UK figures will still be required for all groups, including details of allowance allocations and carry forward figures. As well as helping to identify the risk of a deduction limitation, we can provide analysis to support board discussions on debt structuring and restructuring for the future. We can carry out numerical analysis either on a forecast basis or using prior year figures. The new interest limitation rules start in April 2017. This is a drop-dead date. No grandfathering provisions are anticipated. We at BDO can help ensure that businesses are ready for the introduction of this particular action point. Are you ready for BEPS?